In this game, timing isn't everything. It's the only thing, and right now, the numbers have flipped. Mortgage rates are dropping. Interest rates are below 5%. Thousands of Kiwis are about to refix, and yet, most of them will miss it. But not you. You're here because you moved first. You hear the quiet shift before the headlines catch up. Today, we're back with Kelly Eckhold, Chief Economist at Westpac. If you own property, if you're about to borrow, if you're playing for keeps, this conversation might be the best talk you've heard all year.
Financial freedom faster. Financial freedom faster.
But before we get into it, if you're serious about property, start with the Mortgage HQ Snapshot. It's ripped the lid off the game for thousands of Kiwi investors. No fluff, just a sharp look at your real options. Description below, take that shortcut. Kelly, mortgage rates have been falling steadily. What's the real window of opportunity for property investors right now before the next Reserve Bank move?
Well, I think the Reserve Bank's likely to cut rates in August. They signalled that pretty clearly back in May, that assuming things panned out as they expected, they thought they had another cut in them then. Markets are basically priced for that, though. So we've got mortgage rates sitting there just under 5%. What I increasingly see is that people are recognising that we're close to the bottom of the cycle now with respect to interest rates. So the opportunity there is to start thinking about longer term rates. So increasingly, I think we see people thinking about, instead of the 6-month mortgage, thinking about the 18-month or 2-year mortgage. I think the most competitive, the lowest rate that's available there on the market is in that 18-month segment. And I think that's where banks are competing most aggressively. But there is a bit of interest even out there for 3-year mortgages, where people are saying, well, maybe something around 5% for the next 3 years just takes away the uncertainty that I otherwise might face if I was having to kind of roll the mortgage over more frequently.
Investor lending's up significantly. Are we witnessing the start of a strategic surge or just a temporary sugar hit from the falling interest rates?
I think the investor behaviour is reflecting, yes, the lower interest rates. I think that is an important sort of like driver there. But it's also reflecting the better taxation terms that were given to investors with the new government when they came in.
A return to sanity.
A return to sanity. Well, certainly sort of, from that perspective, the government's obviously been a bit of a supporter of the investor market. So I think that's what's driving that. You've got like a cohort of people that have got money to put to work, and for the right property in the right place at the right price, that's what they're doing. So we're seeing, in terms of the credit figures, that's where the strongest point has been. It's been investors, and then it's been people that already have houses that are maybe trading up something different.
Short-term rates dropping, the cash rates projected to bottom out soon, maybe a cut, maybe another 2 cuts, who knows. How much lower can the mortgage rates realistically go in this cycle, and for how long will they stay like that?
Well, I think on our forecast now, we've got one more cut in August and nothing else apart from that until rates start going up at the end of next year. That would be consistent with mortgage rates around about where they are. Potentially, there could be some additional competition that could just nudge rates down 10, 15 points or so. Something on the horizon that's out there that the Reserve Bank is looking at is reducing bank capital requirements. They've got a review underway. Once we get through to the end of the year, they might let us know what they're going to do with that. And if they end up reducing bank capital requirements, then chances are some of that will flow through to lower mortgage rates for borrowers. But pretty much, I think where we are is close to where we're going to be.
Thousands of Kiwis refixing their loans. How should property owners be thinking about this decision to maximize leverage and long-term gain? I'm not sure what insights you've got on the interest-only lending or whether people are restructuring to lengthen their terms. Do you know what the behavior is with this opportunity now that rates have dropped?
The last data I saw, because that data comes out with a little bit of a lag, was that we just started to see the beginning of the usual behavior when interest rates start to fall. And when interest rates start to fall, what tends to happen on average is people keep their payments the same. So it basically ends up shortening the duration of their mortgage. I think we'll get more data on that as we go through the next couple of months or so, and I would expect to see a continuation of that trend.
Is this the most buyer-friendly lending environment we've seen since before this housing boom took off? And how should smart investors be acting?
You know, I think it is probably very buyer friendly, because if I look at the long-term trend in the stock of houses for sale as a percentage of total dwellings, we basically see that the housing stock available for sale has risen quite noticeably from what I would suggest were really undersupplied levels through 2020 and 2021. We were really scratching around quite hard, I think, to find something you might have been interested in buying, to more like the conditions that we saw around about 2015. So that's a better balanced market. That's a market where there's actually adequate supply available to meet demand. And that is perhaps consistent with the observations that we've been seeing this year that, okay, prices aren't falling, but they're not rising very strongly either. And, you know, that's a classic supply equals demand type situation.
What is the risk with the high unsold housing stock? What if it becomes even more of a buyer's market?
Well, I guess then if the demand doesn't pick up, then naturally that means the pricing needs to adjust. I don't think we see very much evidence of increasing kind of like unsold stock in recent months. It actually looks like it's probably topped out a bit now, because it has risen quite a long way over the last couple of years. The other thing I've got my mind on, though, is that on the demand side, I think things will look a lot brighter when we get through to the end of the year and there are more tangible signs of the unemployment rate starting to fall. Because I think that kind of people's perceptions of their employee, we're way away from the election, I think, where before that becomes a serious consideration. But I certainly think by the time we get to the middle of next year, we'll be right in the middle of it. And, you know, maybe people will be watching quite closely to see which horse they should be betting on. You know, I wonder myself whether when we get to the middle of next year, whether there might be just a bit more money available to be thrown around. Either that's because the interest rates have been quite low for a reasonable period of time, but also you'll have a government that will be presumably quite interested in being re-elected and will be looking at opportunities to provide some support to the economy.
Fixed term mortgage rates under 5%, they're back, as you said, maybe here to stay for a while. How should investors be thinking about structuring debt in this environment?
Well, I think we're increasingly in the zone where certainty probably becomes a bit more of a higher premium. Now, in the last year or so, we've seen a tendency for people to borrow quite short because they thought the interest rates were going to fall a long way quite quickly, and they thought there was some real value for waiting before borrowing longer. I think let's clear that's actually what we're going to see now. And, you know, as I was sort of talking about with some of the more recent trends, tendency has been for people to try to borrow a bit longer. They're still really in the sort of like 1.5 to 2 year type ranges, and sort of around 1 year is sort of like where a lot of Kiwis like to be. But I think we're past that stage now where people want to go floating, or if they want to sit there on a 6-month rate, I think they might quite like to potentially go for a longer rate, and maybe the bank will give them a bit of an incentive as well, because I think there are a few of those available out there for some of those sort of customers.
And what happens if the RBNZ doesn't drop rates August 20th? You know, how is that going to impact the market's confidence to keep trying the best to get things moving along again?
So I think there will certainly be a bit of a surprise in the professional financial markets, because they've more or less entirely priced in that 25-point cut for August. But generally, where interest rates are now are quite close to where they've been for a while now. If you think about the sort of like longer term rates, the 1, 2, and 3 year rates. So I actually don't think that there's much prospect of mortgage rates rising right now.
Kelly Ecole, Chief Economist, Westpac, thanks for your time. But before we go, if you want freedom, not theory, not the mindset, if you want the moves, tactics, and a playbook, then you want the 3 Property Formula book. Now, I've written the strategy real investors use while the rest panic. Built from the trenches, no fluff, no seminars, just results. You want to own the blueprint? grab the book and give yourself the unfair advantage 95% will never get.